Today, California state legislature will vote on whether to advance a universal health care bill that would guarantee coverage for everyone in the state. The measure would create the system and set the rules, but not pay for it. Another separate bill would cover that situation. Spotify is responding after a number of artists said that they would leave the platform if it continues to host Joe Rogan, who has been spreading misinformation about the pandemic on his podcast. The company said it's adding a content advisory to any podcast that includes discussions about COVID-19. And today's top story, interest rates. The Federal Reserve has signaled that it would start raising rates as soon as March. But what does that mean for those of us who have seen the highest inflation in decades? Well, Aimee Picchi is here to discuss. Hey, Aimee, I know that Wall Street's all nervous about this, but I don't know what it means for the regular person. So let's talk about what the Fed has been signaling. How much is the Federal Reserve planning on raising interest rates in March? And could there be more than one, raising of the interest rates? And how will this impact Americans?
Yeah, great questions, Anne Marie. So, the Federal Reserve didn't come out and say, we're going to raise it by this amount, but they're not going to do anything drastic because they don't want to spook the market. They don't want to spook investors. We've already kind of seen a lot of volatility in the market because of people anticipating that these rates will go up starting in March. But, based on that, Wall Street analysts are telling us that they're expecting about 1/4 of a percentage point interest hike in March, followed by several more. So Wall Street analysts are expecting maybe 3 to 4 interest rate hikes this year. So that means by the time we reach this point next year, interest rates could be 1% higher. And, over time, that means consumers are going to be paying more for their debt. I think the biggest point that consumers need to take away from this is that your adjustable rate debt is going to be more expensive. So it means it's going to cost you more to borrow. And the biggest part where this will impact consumers is their credit cards. You will start to see your credit card rates start to inch up sometime after the Federal Reserve hikes rates in March. So be prepared for that.
Not too long ago, we were talking about how wages have gone up, but a lot of those increases were totally gobbled up by inflation. The whole idea of raising these interest rates is to rein in inflation. So though we are going to be paying more to borrow money, is there a positive for us? Used cars are through the roof, 35-40% increase. Houses, could we see the cost of some of these items go down?
Yeah, so that's the hope. The Federal Reserve is doing this to try to rein in inflation with the idea that if it costs more to borrow money, people might think twice, do I really want to buy this? Or are we willing to pay more to buy this item? So, the hope is that inflation would get reined in at some point, although it's going to take a while for that to trickle through, analysts tell us. You're looking at maybe several more months of inflation. That's what analysts are saying. And then maybe by mid-2022, we could see, inflation improving at that point. Mm-hmm. I want to point out, though, that there is another positive to this, which is that if you have a savings account, if you like to buy CDs, they have basically paid very little in interest because it's based on the Federal Reserve funds rate. Those interest rates will go up. So you will earn a little bit more if you're a saver, if you like those kinds of products, you'll get a little bit more for your money in those products.
Okay, thanks for giving us the bit of a silver lining. I appreciate that. Aimee, thank you very much.
Thanks, Anne Marie.